2020. Starting with catastrophic lack of sales in the motor vehicle space. Not a good sign. And unfortunately, what's up is inventory, which basically means that we're going to, in the next 3 to 6 months, experience some major difficulties because of the massive amount of stockpile, generally speaking, across the board in manufacturing. Pending home sales, catastrophic losses, even worse than the last recession, finally catching up on this data. That's further, if you look at the last decade, you can see how big of a drop the sales index has been. One of the big issues for a lot of small businesses that are trying to reopen is that they just don't want to open because they don't expect any of the sales. That's almost 40% of the marketplace. Month of May is having now the largest number of U.S. bankruptcies since the last Great Recession, and that's just the beginning of it. It should continue to go down this route pretty quickly. U.S. dollar, unfortunately, has broken a support level. We'll keep monitoring, but what that is saying is potentially the amount of printing that is being done by the U.S. marketplace relative to the recovery of some of the other economies is that it's starting to wane on the strength of the dollar. Not specifically relevant, but Japan, generally speaking, hasn't been dramatically affected. But there has been a slow uptick in unemployment just recently. We'll see if that scales up even more. Another weird trend over the last decade has been the number of U.S. banks taking a lot of the business from European banks in Europe and the amount of revenue, relatively speaking. So that is an area to look at as it's going to cross probably in less than a decade. This is from Australia, where if you look at total wages and salaries and benefits paid, it's actually increased over this the virus, mainly because of the government supplying benefits. And you can really see that clearly here. I'm sure this is going to mirror a lot of the benefits even in the U.S. marketplace as a lot of the unemployment insurance and benefits kick in. Crude production, as you can see, has collapsed. That is giving a boost, though, to the pricing power right now on WTI crude prices having gone up dramatically from their lows. That being said, you've got a massive amount of fuel that's being stored instead of being utilized from historic highs. First time in history, renewables are actually about to cross higher in consumption than coal in terms of all these different ones here: solar, wind, geo, bio, waste, wood, and hydro as fuel sources. So that's a really interesting turn of events, and that's since the beginning of American history. PE levels in the U.S. stock market, as we've talked about before, pretty high, and even without the returns. So we'll see what happens there. That being said, we think that a lot of this has to do with government spending, obviously, as a percentage of GDP, boosting up a lot of the markets. Not so surprising, we've had continued strength in the hedge fund industry for the big guys relative to the small guys. I think that marketplace is going to just only accelerate further from there. VC market, obviously deals are going down specifically, and valuations are also going down. Not a good sign, and we think that's going to continue on potentially for at least a couple more years to come. Corporate debt spreads relative to rate of expected return on equities, equities being at a pretty high PE ratio currently, doesn't bode well on that side for upside. But on the flip side, you've got the corporate debt side being a little bit cheaper. One thing that's interesting is if you look at the Fed, there has been a decrease in the number of new purchased assets, which is hopefully a sign that there's a bottoming of the marketplace in terms of what the Fed is going to be needed to build up their balance sheet. As you can see here, crossing over $7 trillion on the balance sheet. Hopefully some of these programs will be able to be a benefit, but it's going to be staying on the books for a pretty long time. Over the long term, you can even see even programs from the last recession are still being held on the balance sheet, and we weren't able to reduce that fast enough. And if you look at all those different programs, such as TARP being used in the last recession, we still have a lot of these programs that are still having to be launched, like the Main Street lending facility that we're going to be watching pretty closely. One thing has to do with energy inflation. Hopefully, we're at the bottom of that. And as I mentioned, WTI crude price, hopefully having bottomed here, will allow some kind of increase in that pricing. Tips, Treasury inflation protection security at all-time lows. Relatively speaking, this basically is saying that not expecting to have any inflation build up anytime soon, but we'll see how that ends up happening. Just a random analysis on what types of jobs are doing well relative to telecommuting. This is a pretty obvious chart, but what specifically to look at is, what areas are being negatively affected from that standpoint relative to pay. This is not too surprising. More and more companies are going to be using digital means for a lot of their marketing to try to get to customers. And I think that's a trend that's been growing and will continue to grow. So this just, I thought to throw in there in terms of there's been such a dramatic uptick in the amount of vacation bookings for Florida, even from historic highs, seasonally adjusted. So that may be a good thing, and it may be a bad thing in terms of potential outbreak. We'll see what happens.